Good morning. Today, me and my team will share a summary of this book, The World of Mutual Funds. It will be divided into 7 chapters, and I will share with you the first 2 chapters within the book. Let's get into the first one. The first chapter is called The Guide to Investing. I will now share with you the basic concept of investments. Most of us has grasped the importance of saving. Nonetheless, not many of us really actually know the purpose of saving. A more crucial note is that many people don't know the difference between saving and investing. The most basic difference between the two are 1, a specific purpose or need for fulfillment. For example, the education of your child, or mortgage payments or pension funds. And the second one is the size of amount that is needed to achieve the specified objective. And the third one being when the need is called for fulfillment and how long it would take to achieve that need. The fourth is the varied options of investing that is available in order to achieve the objective. And the last one is the strategy to achieve the objective. So is investing and saving the same thing? It actually isn't. Investing is the process of saving that is oriented towards a specified objective within a specified time frame. When saving by itself is actually just unstructured and not specifically purposed. The choice comes down to either investing or saving. Investing gives you more reaps as compared to savings due to the planning aspect for future prospect that investing needs. The need for investing is basically triggered by specific needs that calls for fulfillment at a specified time in the future. It is important to take into account the living cost of a person will only be greater in the future. Now I'll explain the instruments used in making investments. There are 3 basic instruments. The first is bank deposits. Bank deposits refers to investment made by making a deposit to the bank. The deposit is a form of loan towards the bank, which in turn will give the investor interest above the initial deposit. The second instrument is bonds. A bond is simply a type of loan taken out by companies. Investors lend a company money when they buy its bonds. In exchange, the company pays an interest coupon at predetermined intervals, usually annually or semi-annually, and returns the principal on the maturity date, ending the loan. The last one is stocks. A stock is a share in the ownership of a company. Stock represents a claim on the company's assets and earnings. As you acquire more stock, your ownership stake in the company becomes greater. In investing, no matter which instrument you choose using, there will be varied potential returns as well as the size of risk associated with the instrument you choose to use. Deposits have low risk and low return. Bonds have medium risk and medium return. And stocks have high risk and high return. So that is for the basic concept of investing. Now we will get into the term mutual funds. This is the second chapter. What are mutual funds? So what is mutual funds really? Mutual funds is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. Mutual funds is also a means of investing that is purposed to make investing easier for the people. Investing in mutual funds is done by consulting with an expert. In simplest terms, we entrust our money to an expert which will then take care of the investments for us. There is an asset management service which is certified by the BAPEPAM. In manual investments, we as investors have to grasp the concept of all aspects related to the investment. By investing in mutual funds, all those will be handled by the asset manager. So mutual funds is a solution for people that aren't too keen with the idea of manual investment. Investing in mutual funds gives the investor the benefits of 1. Access towards the instruments. 2. Portfolio investment handling by the professionals. 3. Diversification of your investment with a low cost. 4. Relatively high liquidity. And the last one is potential of high return in the long term. So the asset manager is tasked on analyzing the macro and micro environment, deciding the allocation of the investor's asset, deciding the sector of allocation, deciding the party to allocate in, and monitoring the performance of the investments made. So mutual funds takes numerous forms. So there are a couple types. The first one is money market mutual funds. And there's constant income mutual funds, stock mutual funds, combination mutual funds, structured mutual funds, exchange traded fund, and Sharia mutual fund.
Okay, now we are going to the chapter 3, which is the understanding of prospect of mutual funds. So the definition of prospective is a legal apps is managing investment policy, risk, procedure of buying and resale, and etc. It's prepared by the investment manager The content of prospectus is sourced from the collective investment contract certificate or KIK made by the investment manager and custodian's bank. And it's available on any account opening form or purchase form of mutual funds. So the contents of the prospectus is the first one is summary, the legal basis is public offering, investment manager, custodian banks, investment objective and policies, taxation, demand risk factor, allocation of risk and reward, rights of holder of equity unit, dissolution and liquidation, legal income, account income on the financial statement, requirements and procedures for purchase of investment units, terms and procedures for resale or redemption of investment units, and the prospecting spreads. The legal basis of mutual funds, there are several things. The first one is the investment manager and custodian's bank make the KIK, and then after that the legal basis for the establishment of mutual funds, and then the KIK articles of association and laws, or we call it as ADART of legal entity, and then base of mutual investor to comply with the provisions, and then the explain terms and condition of mutual funds, and then for potential investor in the form of prospectus, and then the mutual funds in Indonesia form on the basis of KK and in the form of PT. And then the fund legal basis is just they are like the for the fund legal basis there is like closed-ended funds, the open-ended fund, closed mutual funds. After the initial offering, investor will trade buy or sell the share with other investors through the stock. Open-end funds, the investor will transact directly the company with the mutual funds, KIK mutual funds to investment manager. Then the investment managers, the role is to determine the performance of mutual funds, to find out information that has not been disclosed in the prospectus. And then the investment objective and policies is to maintain liquidity and capital protection and revenue with emphasis of capital stabilize and long-term capital growth. In the investment policies, they are which will determine the type of mutual fund potential and risk profile of mutual funds. Is explaining about the first one, investment allocation for each instrument type. The second, the type of bond and the type of stocks that will be an option. The three, allowable investment limits and prohibited transaction. The taxation of mutual funds is paid by investor collectively through mutual funds. Includes first, dividends of shares, stock transaction on sale, interest on deposit or SBI, com, paper and other debentures, BND and bond and bond capital gains. The major risk factors is like the first one, reduced unit values, or which there are like default, change in the market values of securities in the mutual funds, and changes in economic, social, national and international condition. Quick or slow get cash is the slowness of investment manager to sell the portfolio to get the cash depends on the condition of the securities liquidity concern, and contaminate in the fluctuation of the units participants from the time to time. For the charts, there's like the cost charges to mutual funds, cost charges to directly to investors, and the participant unit holders is rights is for participant unit participants or investor, and the rights is obtain proof ownership in the form confirmation letter or monthly assessment in the sent by custodian bank through the sales again, resale of the unit participation through the sales again to forwarded to mutual funds, obtain information on the net activation value unit participation calculated daily by custodians banks and loaded in bank daily, financial reports and practice acted that will be prepared by investment manager and available to the ratios. Option profit sharing or dividends when the division is made for money market mutual funds deals by daily basis. Obtain the proportionate share property that case mutual funds is liquidated or dissolved.
So we are now in chapter 4, which is about net asset value per unit, investment return, and performance of mutual fund. So first point is the definition of net asset value per unit, which is the net asset value per unit of a mutual fund, and function for investor. For the function is for investors, such as the buy or sell price when the investor buys or sells the unit of participation of mutual fund, as an indicator of profits or losses on investment made in mutual funds, and investment value determinants that we have at a time, as also as a means to know the historical performance, as a means to compare the historical performance of a mutual fund and other mutual funds. And also the other function is the net asset value is calculated by custodian bank and announced to the public every business day through daily business. And also ups and down, the net asset value equals to up and down the value of your investment. So the net asset values rise and fall depends on whether or not the performance of the investment manager or general market investment conditions. So the second point is an example of mutual fund sale and purchase transaction, and the third is a net asset value per unit is an indicator of investment return, and also calculating investment returns, and also cash distribution or dividends. So for this dividends, the objective is to provide cash periodically without investors needing to resell, so that no resale fee is charged, and also taken from the accumulated investment yield reflected from the increase in net asset value per unit. Also, dividend distribution will automatically decrease net asset value per unit, and money market mutual funds equals dividend distribution is done daily. For the sixth point is calculating the net asset value per unit, and then example of calculation of net asset value per unit. And then the reason for net asset per down unit is changes in market prices of existing instruments in mutual funds. And the next point is fundamentals of performance calculation of mutual fund. And the 10 points is publication of mutual fund investment results, which is every day. So the section published on net asset value unit in 31st December, 30-day results and first results, comparison with the previous net asset value per unit 30 days, for example 1 December, and net asset value per unit the previous year, 31 December. So we're now moving to chapter 5, which is investment management of mutual funds. So the first point is the types of investment instrument, which are money market instruments, debt instruments, stock instruments. And the second point is investment process diagram, and then an example of asset allocation, analysis of the industrial sector, and company analysis and investment universe. And the other points are examples of portfolio models and implementation of investment. So for the implementation of investment with the portfolio model, the portfolio manager applies the model to multiple portfolios that share the same investment policy. And buy and sell decision means portfolio managers evaluate the latest state of each selected company and monitor and analyze macro market conditions. After the decision, they instruct the dealer to contact the broker to execute his decision. So the broker executes through the exchange against the dealer's orders, and the dealers will request the operation and settlement section of the investment manager company to order the custodian bank to settle the transaction and record it in the portfolio accounting. So, and the next point, there are monitoring and adjustment, which is monitoring macro and micro market condition. Apa sih namanya? This monitoring and adjustment is to find out whether investment objectives are achieved or not, and if there is a change and cost portfolio performance does not reach the goal, the investment manager needs to make changes and adjustments to the asset allocation and portfolio models. So make change is fundamental analysis of the latest macro and micro conditions and technical analysis and market sentiment. And the ninth point, the effect of asset and tax allocation on fixed income mutual fund investment returns, which is the most important factor in determining investment performance. So there are investment yield, which is calculated based on weight average of percentage of allocation of each instrument, and also fixed income mutual funds, which is trying to place the largest portion of bonds possible after considering the need for liquidity to pay for redemption requests or resales. This means to optimize the expected investment return. And also the last is to roll. The role of taxes is also very meaningful to provide added value to investment returns.
Now we're talking about Chapter 6, which is Understanding of Reporting Performance of Mutual Funds. So Fund Fact Sheet is an important brief report for investors and potential investors, which is published once a month by investment managers and mutual funds managers. The purpose is to simplify investors to compare between one mutual funds and other mutual funds. The comparison between mutual funds and the process to evaluate the portfolio performance we owned is important in the process to choose a mutual fund for investments. The fund fact sheet consists of brief profile and asset development managed by the investment manager, the purpose and policy of asset allocation of the mutual funds, the outline of the portfolio composition at the end of reporting, the obedience of the investment managers toward the investment policies, data of the top 5 holdings by the mutual funds, development of mutual funds portfolio, historical performance, and performance development benchmarking if available, and other information such as the amount that is managed, NAV per unit, and cost. The first part of fund fact sheet is the brief information regarding the investment manager as the mutual fund investment manager. The things that the investor needs to know about investment managers are the shareholders, because some of the investment manager is a subsidiary of a financial institution or global investment manager with a wide international connection. Experience as an investment manager, both nationally and internationally, asset under management until the end of certain period of reporting, and the client's portfolio. Because the investment manager not only managing mutual funds, but also managing other clients, both institutions and individuals, in the forms of discretionary portfolio management. The investment objectives and policies will determine the type and level of risk of correlated mutual funds. The objectives is followed by investment policies in the form of asset allocation, distribution of investment placement to the investment instrument. There are 3 investment objectives. The first one is liquidity and capital protection, and the investment policies is forex, a high revenue and capital stability, which the investment policies is obligation, and the last is long-term capital, and the last one is long-term capital growth, and the investment policy is stock securities. The brief information regarding the composition of portfolio is percentage of investment allocation that has been done in the chosen instrument until the end of reporting period, which is the end of the month. And things that needs to be concerned is the how is portfolio in composition and which instrument has the biggest allocation. The top 5 allocation for moderate mutual funds are government bonds, Indosat bonds, Telkom bonds, Pawn Shops bonds, and Bank BCA bonds. And the top 5 allocation for progressive mutual funds are government bonds, HM Sampurna bonds, Telkom stocks, Gudang Garam stocks, and Indosat stocks. The last part of fund fact sheet shows other informations such as date of public offerings, investment policy, investment currency, total amount that is managed, cost, and NAV per unit. This information, plus with the information regarding performance, can be used to compare funds in order to evaluate the mutual funds. The closing part of fund fact sheet usually consists of disclaimer, which is a warning for investors that consists of performance report. It is not an offer to buy or sell the related mutual funds. NAV per unit can rise and fall. Past performance cannot be categorized as benchmark for future performance. There is no guarantee for return on investment. And the last is the importance to read prospectus before investing.
So hello, now we are going to chapter 7, which is how we can take benefits of mutual funds. Now we are already in our last session. In this session, we will learn how to take benefits of mutual funds in the framework of investment planning. We will talk about first defining the investment objectives and future needs, doing asset allocation planning, choosing the type of mutual funds that is fits the objectives, and the last is monitoring and evaluation. So mutual funds or reksadana is a vehicle for investment. If you finally decided to choose mutual funds for your investments, you better have a plan before you implement it. There are some steps of planning you need to do. First, you need to define your objectives. You need to collect data and do some data analysis in order to define your objectives. And second, you need to develop a plan to design the asset allocation strategy and continue with the implementation of that asset allocation strategy through mutual funds. Because you like it or not, there will always be changes for some reasons, whether within yourself as the investor or the market condition. Monitoring and adjustment is needed to keep the investment so that it can be systematic, dynamic, and sustainable. The main factor why someone needs to invest is that the future needs. The main factor why someone needs to invest is the future needs. Other factors are also considered, such as lots of uncertainty, for example, cost, cash availability, health conditions, disaster, market conditions, and inflation that always increases. With a lot of investment for investing, a lot of instrument for investing, such as mutual funds, you can easily prepare and fulfill your future needs. You can decide your priorities, you can make good planning, and implement your strategy. So as we already know, prices increases from time to time because of inflation. This inflation factor must also be included in our consideration to define our investment objectives, besides how much the amount needed. For example, if you note the price of a car is 150 million rupiah today, with 10% inflation each year, for example, the price of that same car will be around 390 million rupiah, nearly 400 millions. Without a good investment planning, it seems to be impossible to reach those future goals properly. A good early planning will certainly help easing the cost of our future needs. So another example of an important investment objectives is child education. Let's say the cost of an undergraduate program today is 140 million rupiah for 4 years. In the next 20 years, considering 8% inflation each year, the cost will be around 650 million. Let's say you choose an investment that yields 6.4% per year. It means that you need to allocate around 1.4 million monthly for the next 20 years. This is an example that you need to collect data, and then you can do some analysis to your investment need. So the next is time. That is also an important thing to consider. It is related to how much money you need to invest each period. Let's say from the previous example, you need to allocate around 1.4 million per month for 20 years. If you delay it for 5 years, you will need to allocate 2.2 million per month. If you delay it for 10 years, you will need to allocate 4 million a month. And if you delay it for 15 years, you will need to allocate 9.3 million per month. This is what we call the cost of waiting. The earlier we start investing, the lower the cost we need to allocate. So now you have already set your objectives, your goals, your targets. The next step is to decide the strategy for asset allocation plan, and this will depend on the objectives itself. Also on how long is your tolerance to risk and the time frame needed for each of you to reach your objectives. For example, do not invest your liquid savings in stocks. On the other hand, stock investment is suitable for long-term needs such as child education funds. Usually there are 3 types of alternatives based on your risk tolerance. The first is low, the conservative investor. You can choose bank deposits. The second, moderate investors. You can choose the combination of mutual funds and currency exchange. And the third is high or the aggressive investor. You can choose the combination of mutual funds, forex, bonds, and stocks. So the last part that is also important is the process of investing. In the process of investing is monitoring and evaluation. This is done periodically, at least once in a year. This process is crucially needed because changes happen over time, whether from internal aspects or external factors. So the monitoring and evaluation process includes these following steps. The first is that you need to calculate the return from each investment portfolio and compare with your objectives. Second, you can also compare the mutual fund's performance with its benchmarks or other similar mutual funds product. If the return is not as you expected, you can change yours. And the third one is that do some adjustments if you need it. For example, your income increases so that you can allocate more money to invest, or there is another objectives come, or the market condition changes significantly. So that's all for chapter 7. Thank you for listening.